And welcome to this fireside chat of the Center on Regulation and Markets at the Brookings Institution. My name is Sanjay Patnaik and I'm the director of the center. In our series of fireside chats, we explore important topics at the intersection of modern-day markets and regulations in one-on-one conversations with business executives, regulators, and academics. Today, it is my pleasure to welcome Dante Disparte, who is the founder and chairman of Risk Cooperative, a strategic risk advisory and insurance brokerage firm in Washington, D.C. He currently also is the vice chairman and head of policy and communications for the Libra Association. Dante has 2 decades of experience as an entrepreneur, business leader, and global risk expert. He has lived and worked in Europe, the United States, and the Caribbean, and he also serves as an appointee on the National Advisory Council of the Federal Emergency Management Agency, short FEMA. He is a founding advisor of the Global Blockchain Business Council and a senior fellow with the Blockchain Trust Accelerator, where he supports technology and digital transformation initiatives. Dante is a graduate of Harvard Business School and holds a master's in risk management from the NYU Stern School of Business, as well as an undergraduate degree from Goucher College. He is the co-author of Global Risk Agility and Decision Making and was recognized as one of the 40 leaders under 40 by the Washington Business Journal and in the inaugural Power Meter 100 list. Dante, thank you so much for being here today and welcome to our fireside chat.
Thank you, Sanjay. Great to be with you.
So it is wonderful to have a risk expert here today because as we see nowadays, we have so many risks currently facing the world economy, right? And you have founded a company focused on risk management and have spent years thinking about different types of risks and how to best mitigate and manage them. So could you please tell us briefly about your work in the risk management space?
Sure. Well, so, prior to joining the Libra project, my work was really framed around risk management and how do you transfer emerging risks to another organization's balance sheet? Effectively, how do we look at insurance transactions and find out how to bridge what we would call technically the protection gap? So the spread between economic risks that show up in a marketplace and whether or not they can be priced and effectively hedged through a private market process. So up until 2014, I was the managing director of a global firm operating in this world of insurance and addressing complex risks all over the world. And I realized that there was a gap in the market, that we needed a little bit more creativity, more entrepreneurialism, and more innovation in effectively that risk transfer process. And so that's how Risk Cooperative was born. And we really tried to address all manner of emerging risks. It's the subject of my book, Global Risk Agility, and it's the subject of a lot of the work that I do, including on FEMA's National Advisory Council, is how do we address these intangible events that are increasingly occurring. They're more likely, they're big, they're going to cost billions and billions of dollars and require a whole of society response. How do we ensure that there's a little bit of private sector participation in mitigation, hedging, and recovery against that type of landscape?
Mm-hmm. Very interesting. And so, I mean, if we look at the current risk landscape, obviously the 2 major ones that come to mind are COVID-19 and climate change. But if you leave those separate for now, what other additional risks do you see currently that the global economy is facing, and then maybe the US specifically?
Yeah, I mean, well, lest we forget, right, that today we live in a world, because of COVID-19, the intersection of technology and business and government and operating continuity has been made painfully obvious, right? Companies going into this type of crisis that had a liberal posture in terms of work from home capabilities were much more resilient compared to organizations that required a physical presence at an office, as one example. And clearly there are some industries where the lack of physical presence is not an option, right? People at an assembly line is a key production input. But nevertheless, cyber risk, technological continuity, and effectively this whole world of digital transformation can be at once a risk and an opportunity to an organization. And I think the crisis has really laid bare how greatly dependent our global economy really is on technology for anything in the way of operating continuity. And those dependencies, everywhere where you see that dependency, you also see a potential point of vulnerability. And I think a lot has yet to be addressed there. The other one that I think is fascinating and requires much more study and work is we keep talking about we keep talking about data being the new oil. And yet for data and for information privacy and how data is then monetized, we don't yet have a generally accepted accounting principle for how to value data, and at the same time, how to show how it shows up from a risk point of view in an organization's balance sheet. So until we start to define the economic consequences, both the upside and the downside of data, I think it will remain one of these big intangible sources of risk and complexity in the system that requires more harmonization in order to identify what it is and how it shows up.
And I think that's a really interesting point, actually, because I mean, data is so central to many of the new modern business models that we see nowadays, right? But we just don't have enough of these frameworks to actually manage some of the risk.
Exactly.
Great. So I want to move to one major risk category to really dive a bit more deeply into it, which is climate change, right? So this is what my own work is on, and a lot of your work has been on that. And so we know that climate change has long been predicted by scientists, and we're already experiencing its effects all over the world to a significantly larger degree than even scientists expected. And so if we look at climate-related risks, what are the risks that you're most concerned about on a global scale, and then also in the United States?
Yeah, look, if we weren't talking about COVID-19 or the prospect of ongoing political risk, for example, in the United States and other advanced economies, the headline subject would be climate risk, right? We have had thus far the most named Atlantic storms and hurricanes at any time on record. Those storms since at least 2017, if not much earlier, have become larger, more persistent, and more devastating. The Harvey, Irma, Maria trifecta of hurricanes in 2017, I think, marked an opening act of what the Atlantic hurricane season could look like. Under the guise of these are anthropogenic events. These are events that are effectively spurred and accelerated by climate change. And then you take the California fires. I say all of this because this would be the principal and only topic we would be discussing right now if it weren't for COVID-19 and if it weren't for political risk effectively being headline issues. Yeah. So those all scare me because every single one of the events that I just mentioned, Hurricane Harvey in 2017 triggered effectively the flooding of the fourth largest city in the United States, Houston, and a choke point for 25% of the country's oil refining capacity. The California fires, similarly, something you and I have discussed at great lengths, also blur the lines between what is public infrastructure in the form of PG&E and the electrical utility and what is a private sector line of defense and line of accountability. And hitherto, up until now, climate risk hasn't necessarily shown up on an organization's balance sheet, so it's not priced in. This is what I call unincorporated risks or unincorporated costs. We have to start figuring out how to price them into the system. And once we can do that, we could appropriately assign accountability, develop hedging strategies, and become more resilient to these types of events.
The last one is actually quite interesting. So let me maybe follow up a little bit on this. As you said, a lot of the risk has not been priced in. And effectively what we are seeing now is that if such extreme weather events happen due to climate change, most of the costs are being borne by taxpayers, right? And insurance companies to some degree, right? So what kind of models can you think of or envision that could price in that risk and shift some of the burden to private actors, right? Because even for very rich countries, it will not be sustainable to have billion-dollar damages multiple times a year to kind of like pay out these huge damages to private participants, right?
Yeah, well, you hit on one of my sort of key focal points in the advisory work that I'm doing with FEMA, but more generally speaking, something that we can observe in the market, right? Which is that in the 50 years or so between until 2000, on average in the United States, we had about 20 disaster declarations over time. The national average today in the 20 years since 2000 is roughly about 130 declared disasters in the country. Wow. And so irrespective of causality, that is an operating environment for the emergency management field, the risk and response field, and ultimately the financial markets that can no longer ignore causality. I mean, the debate for causality in that kind of market environment is over. It's time to respond to the effects, right? Mm-hmm. Those effects increasingly are being passed on to the taxpayer with no private balance sheets in the middle. Mm-hmm. I first think of that as a market failure, as an entrepreneur and as a business person in this industry. I don't think there's anything as a bad risk. There's only a mispriced risk. And so the failure of uptake rates on flood insurance, the failure of uptake rates on earthquake insurance, notwithstanding the fact that these are pretty predictable events with great statistical accuracy and actuarial soundness, The failure to price them accordingly is partly a function of supply, meaning the insurers and the public sector that offer these solutions aren't offering them in a manner that's compelling or acceptable or accessible to the market. And it's a failure of demand, because those sectors that believe and those communities that believe the cavalry is on the way are learning the hard way that the agencies and the lines of defense that we have are often the last in line rather than the first in line. And this is where the taxpayer is picking up the tab. Flood insurance penetration is in low single digits. Earthquake penetration, insurance penetration is in low single digits. And we're learning the hard way that there's no balance sheet in the middle. And so these costs are being passed on to the public sector. In that environment, that's a market failure. Ways of addressing it will require innovation, technology, public policy to come together and figure out how to appropriately price an all-hazard strategy towards funding national risks that are borne by taxpayers in more strategic ways. But we've yet to see those types of models emerge.
Interesting. And have you seen any evidence, if you look at the insurance industry, right, that insurance companies are saying, oh, I'm not going to provide insurance for certain areas anymore, for certain houses, maybe in California where the wildfires are happening, or in Florida because of the hurricanes, or the premiums have gone so high that people can't afford it. So what has your experience been if you look at the last maybe 15 to 20 years?
Unquestionable climate change redlining or disaster risk redlining, right? To use a stark term to drive home the point, that we have these oddities in our financial system, both for the access to finance and capital on the growth side, but also on the risk hedging side, where the people who could afford it the least pay the most. In the disaster risk world, we talk about the fact that the vast majority of disaster-prone areas and those who are most affected are low-income households living in low-lying areas and low-quality homes. And so the brunt of these events, 2050, the Hurricane Katrina is a case in point. The post-Katrina population has never recovered since the storm struck, in no small measure because the people who bore the brunt of that event were largely uninsured or underinsured. And effectively, there was no possibility of recovery because it was a total loss, right? So this is where the economic impacts of these events, the second and third order cost, aren't really being factored in. So back in 2015, I was a part of a partnership with Lloyd's to introduce something called the City Risk Index between Lloyd's, Cambridge, and Risk Cooperative, the Cambridge Center for Risk Studies. And what we looked at in that report was this concept of GDP at risk, to start to frame for policymakers and public leaders a different model of thinking about risk that was more focused on long-term resilience as opposed to risk avoidance and cost. Otherwise, risk will always be seen not as something you could invest in. And the City Risk Index starts to frame what is the GDP at risk in a city vis-a-vis a series of different emerging threats and threat categories. In that vein, you played a loss aversion as a motivation for focusing on risk as opposed to fear.
Oh, that's very interesting. And so if you look at risk frameworks, existing ones, right, and stress tests, I mean, there are tools out there that governments use, that insurance companies use. Do you think the quality of these current frameworks is good enough to actually capture some of those climate risks? Or do we need a shift in additional models, additional thinking?
Yeah, I think, first of all, capturing climate risk is pretty straightforward, frankly.
Okay.
In the sense, capturing it from an exposure point of view is straightforward. Capturing the economic consequences needs more work, right? Hence bringing up this concept of GDP at risk and a second and third order set of economic variables in looking at what the costs are. Governor Gavin Newsom in California, for example, after a couple of years ago in the last round of fires that the state had, indicated, look, this is $100 billion event for the government and the state of California to effectively address the persistent exposure of wildfires. Who is funding that $100 billion? How is it funded? And whether the private sector or not sees a viable pathway in funding that and or recognizing climate risk on its balance sheets all remains a public policy question that's open. But from a risk management point of view and an actuarial point of view, to be able to quantify what the impacts are for climate change, how the impacts will affect a single entity, a single interest or business, let alone in a community. I think there's a lot of variables that we could bring to the table for addressing this. What hasn't happened yet is the policy environment that it enforces a posture in which companies have to invest and divest in lockstep from harmful activities that are making matters worse and from activities that can help mitigate these events when they happen.
And so actually, that's a good segue to my next question. If we look at companies, right, have you seen evidence of companies actually being motivated to incorporate climate risks on their own in decision making? I saw recent studies by McKinsey and others that said that a lot of companies, or a majority of companies, do face some climate risk, but very few actually conduct systemic assessments and then incorporate those assessments into their decision making. And so I'm curious what you have seen in your work, what kind of like the voluntary efforts are in the private sector.
Yeah, I mean, I do think there's a growing, although still small, cadre of companies and best practitioners that are starting to realize that resilience is an investment destination. And as a result, the governance frameworks around resilience to emerging risks, climate risk being the principal one, but you also can go down the stream of socio-political risk and market activism, what some would characterize as millennial socialism, and companies finding themselves on the receiving end of market activism are also finding these are balance sheet eroding events and market value eroding events that invariably you either manage them or they will manage you. So I do think there's a growing wave. I'm particularly heartened by the fact that a lot of large capital providers and others are requiring that the capital they're exposing in a marketplace starts to become decarbonized, as one example of a posture that you could put in place across an investment portfolio. You're also seeing a lot of companies starting to really demonstrate in some of their management reporting and otherwise a deeper commitment to reporting on intangible risks and risks that have an operating horizon perhaps beyond how companies report in quarterly cycles and stock market cycles. So there is an emerging requirement here. The challenge is, of course, it's not standardized. There's still quite a lot of regulatory arbitrage taking place in terms of where companies are operating and what type of latitude they might have vis-a-vis climate risk in different jurisdictions around the world. But this is only an area where we can improve upon.
Oh, interesting. So that means, based on what I'm hearing, is a lot of this seems to be driven by investors. Investors saying, I don't want my money at risk here. And so now the question is, if we look at financial market regulation, right, what kind of regulatory measures do you think in the United States we could take to actually force companies to disclose climate risks? And which agencies should be responsible for doing so here?
Yeah, so this gets to one of these interesting sort of economic points, right? The concept of a double jeopardy. So a double jeopardy is a source of risk coming from two areas, and I think the double jeopardy is what many operators and many large balance sheets have to report on as asset liability management. So in the world pre-climate risk, center city office space is considered an asset. Because the presumption is that center city office space will always be attractive. You will always have tenants in that center city office space. But post COVID-19 and in the era of climate risk, center city offices are in fact a liability. The likelihood that tenant rates and ongoing rental income is guaranteed is now under great strain from a variable that wasn't contemplated in these financial models. At the same time, in a large scale disaster or event, whether it's a blue sky event in which there's no physical damage, or whether it's an event like an earthquake or a flood or a fire that causes physical damage, those center city offices are effectively showing up as liabilities. Yet that double jeopardy isn't observed, and nor is it priced into financial markets. So I think that's one thing that a regulatory and a public policy environment can start to call for, is better disclosure of where these types of financial double jeopardies exist. And how do we start to quantify them? The other piece of the puzzle, and this is where I think we have to be somewhat thoughtful and even keel in a regulatory approach to addressing these issues, is that there's a very big blurred line between what is a private sector asset and what is a public sector requirement or a requirement of people and communities. The fact, for example, in the COVID-19 pandemic that we had to turn to war powers in order to divert private balance sheets and supply chains to build N95 masks and ventilators and so on tells you that against big societal risks, we need big societal responses. And the last thing you want to promote is an operating model in which people try to hoard their assets and protect their assets at the expense of their communities. So disclosure is a beginning point. It's not the end point, but I do think finding those double jeopardies will help us find sources of hidden risk.
So that's very interesting. And which agency do you think would be best equipped to deal with this in the US? Existing agencies, or would we need a new one, do you think?
Yeah, well, I think part of it is there's a special obligation on publicly held companies, as the name suggests.
Yeah.
They have a higher duty of care and a higher standard. Your and my retirement ambitions are in the hands of these companies and their leaders, as much as educational aspirations and other long-term aspirations are in the hands of organizations in public markets. I think here we can instill certain market conduct that would put a premium on organizations that are resilient against emerging risks, climate risk, cyber risk, and others, to appropriately disclose what these are. Market conduct in a free market economy is going to be the best driver of the type of change we're requiring. And so the gatekeepers of that kind of market conduct ought to come up with a harmonized posture for climate risk disclosure that would cut across markets, as opposed to getting parochial and having different approaches for different entities. Because I do think, like cyber risk, these are risks that affect entire industries and entire classifications, and they're not idiosyncratic. They're not affecting one industry or one firm on their own. They show up in complex ways across an economy.
Oh, that's interesting. So I think the SEC might be a good starting point, for instance, right? If you look at that potentially. Okay.
Absolutely. Well, it gets back to this concept of the failure of any one bank erodes confidence in banking. The failure of PG&E, the California public utility, or the electricity utility in California, with no alternatives, is bad for private industry as much as it's bad for the California economy. And so figuring out how to price and demonstrate where these double jeopardies show up and how to disclose them, I think, is in a collective market interest. It's not about adding the cost of compliance to private operators.
That's interesting. And so another aspect of this is that we need information, right? We need information on risks. We need data and different models. And if you look at the landscape out there are a lot of different forecasts, climate scenarios, different data and models that are being used. And there's not much consistency across different organizations in their practices of how to use those models, right? So how do you decide as a decision maker which models and data to use? And do you think there might be a role for regulators to harmonize these approaches, to kind of like help companies with these decisions?
Yeah, well, it's a fascinating question, Sanjay, and frankly, it's one of these issues that exposes this concept of model error. We've heard cases, for example, in the COVID-19 crisis, of countries that reached the limit of Excel's computing capacity, the Excel spreadsheet's computing capacity, in order to report on data. So I think we have to be cautious about how models are being introduced and what type of dependency we put on models, because statistically, time and time again, we often completely miscalculate not only the likelihood, the impact, and the severity, and the incidence rate of complex events, and how there are nearer horizon issues than we might take into effect. And so too much dependency on models is often perilous. But no data at all and no measurement at all also means functionally you're not managing something. I think there has to be some equilibrium here. What I would like to see is, for example, on this enterprise value of data question we discussed earlier, on demonstrating what climate risk looks like and how to show climate risk exposure on a balance sheet, all of this will require the accounting practice actually to come to the table. And start to create harmonized standards that are generally acceptable as reporting criteria that then companies, managers, and financial officers and others can report on, rather than companies coming up and frankly obfuscating on their own right in how their companies might be special, or their firms or industries might be special, and not subject to this kind of harmonized approach to reporting. That, to me, is the layer that's missing. More work could be done there, rather than introducing complex models. Complex systems and complex models fail in complex ways.
Yeah, that's interesting. And so moving a little bit towards your role at FEMA, right? So climate change will obviously challenge FEMA quite significantly in the future. That is to be expected with more extreme weather events. And so if you look at the federal government, right, how do you think the government and FEMA specifically should prepare for an increasing number of extreme weather events that will happen due to climate change, and overhaul maybe some of the policies like the federal flood insurance policy that need adjustment and adaptation, frankly?
Yeah, I mean, first, the discipline, the professional sort of discipline of emergency management has evolved over the years, but it is also now facing, I think, nothing short of a transformational process in the years ahead to address the question of COVID-19 is a special event, because what's unique about it is that all 50 states and US territories had a declared disaster at exactly the same time.
Wow.
And the remedy for that declared disaster was all 50 states and territories requiring the same exact, very simple to manufacture items as the first line of defense: PPE, personal protective equipment, N95 masks, and ventilators. So an event that caused no smoking crater, in which the emergency management field was evolved and created, required nothing short of military style precision and logistics and supply chain management in order to equip people with very basic material.
Right.
You know, a FEMA and a America and a US that can respond to these types of events needs to have that type of capability to be ready at hand as a whole of government, whole of society, and household level priority in order to ensure first line defense all the way up to national, federally coordinated defense. The challenge is that the operating model, at least in the public's eye, is that FEMA is a first line of defense agency, when in reality it is not. Flood insurance and the uptake of flood insurance is meant to be a remedy for, you know, ideally not just building on the banks of flood prone regions in the same brick and stick housing models that are vulnerable in the first place, but ideally we should create a model that incents loss prevention at the design level and at the community level, rather than paying for a disaster after the fact. I think if anything we've learned in the last decade, we can't buy insurance when the house is on fire. We can't plan for pandemics and communicable diseases when they're spreading. All of this type of prevention capability needs to be harmonized, prioritized, and invested in. And the first line of defense against these big complex events are households. Community level defense has been the best remedy we have.
So actually, to that last point about households, right? If you are an individual or you have a family, and so how can you make informed decisions about your exposure to climate change, right? You have a limited amount of assets, a limited amount of cash, probably most families do. And so if you buy a house, how do you decide, for instance, where should I buy a house that might still be there in 20 years, or where am I at risk that the house gets hit by a hurricane every 2 years? Are there kind of like risk models or like decision-making points that can help private customers along?
Yeah, it's a fascinating question. You know, so I wrote an article in Forbes a couple of years ago that called for climate risk disclosures to accompany the mortgage lending and origination process, right? So when you think about the process of being a homeowner, effectively the realization of the American dream, you, the borrower, have to go through all of these risk disclosures, your credit reporting from multiple bureaus that tell you and tell the lender your default probability. Think about all of the disclosures that are inherent in any financial transaction, from a car to a student loan to a home loan. Everything we do to manifest the American dream has risk disclosure at the edges, right? Or at the core of those business processes. Yet, as the person who takes on the risk, the homeowner has no pathway to understand, you know, not only climate risks, but other potential insidious risks that may lurk around a home that are permanent, such as, is the property near an asbestos disposal or other commercial industrial waste site? What are the hidden hazards effectively around that transaction? There is no harmonized or standardized way of doing that today. That ought to be included, because this is not only the biggest financial investment we're liable to make in our lifetimes, but it's increasingly finding itself in the line of sight of big complex events. There's also, in the risk management world, there's this concept of loss of attraction. The fact that New Orleans has never recovered its post-Katrina or pre-Katrina population levels is what is known in the insurance and risk management industry as a loss of attraction. If there is a bombing in a community, it takes time for that community to recover because of the implied overhang of that terrible event. So that happens across a spectrum of events that also erodes the economic viability of a community. And so hidden risk disclosure should be standardized and should be a part of an origination process for lending and auto loans and a different series of financial transactions for which we are obligated over a long horizon, 30-year horizon. But we have no sense of what that 30-year horizon might produce from a risk point of view.
And it's a huge liability, right? Because this is where most of the assets are tied up for the majority of families. And so if that risk is
Absolutely.
not known ahead of time, that just puts a lot of that value at risk.
Well, and think about precisely how that then shows up on the public balance sheet, right?
Yeah.
If there's no lender default or grace periods being offered to communities that are affected by a large scale event, a disaster, a blue sky disaster, you know, irrespective of the cause, if there's no lender default or there's no grace periods that are being put in place for rental payments or mortgage payments, those communities are then going to be depressed, right? Economically depressed. And then you have the spin-off effect of vacant properties standing still in communities, which then erode the attractiveness of other properties in those communities. So this is in our best interest to figure out how to standardize and normalize these types of hidden risk disclosures. And they're all about preserving long-range asset values and being very transparent that notwithstanding the fact that the risk landscape is changing, there's still a pathway of having a vibrant economic model around real estate, mortgage lending, and other forms of lending. But this should be priced into the system.
Yeah.
Not a moral hazard, which is risk taking without bearing the consequences of those risks.
And so you already mentioned disclosure is a really important aspect, right? And so currently we have a lot of different types of disclosure, different organizations like the Carbon Disclosure Project, providing different data points. If we had to prioritize different types of information that we need to disclose, what do you think is the most important data and information to have? And how could we standardize those? And should we standardize them?
Yeah, I mean, there's a lot to be disclosed there's a lot to be disclosed that is readily available. The challenge is it's not in a user-friendly or accessible form. Flood mapping information, for example, is readily available. It's not yet in a standardized, usable form to the average person in the value chain. And these are fundamental questions that we're all going to face. You know, after Paradise, California was wiped off the map by the fires a couple of years ago, the question of Build Back Better, which is a powerful rallying cry for communities that are struck by these types of disasters, there's another question that should accompany it, which is much more subtle, which is build back at all. So Build Back Better is a powerful thrust, and that's part of what will make people resilient in terms of their personal attitudes. But there's also something to be said for, should we build back at all? If we know a community is flood prone, and every single year what were once 1 in 500 year floods are now occurring with the regularity of every single year, there's a core question that should be asked, not only of the community, but of the financial markets and the public sector responses of, is it prudent to build against that kind of floodplain? Is it prudent to build inside a fire-prone environment? Is it prudent to build along coastal areas that are subject to very busy Atlantic hurricane seasons, which are now a regularity? Every year for the last 5 years, every event that we would track has become worse, exponentially so. So in that kind of operating model, we simply shouldn't assume that we can continue paying for what is known as the principle of indemnification. In an insurance contract, you will only get back what you lost. Nothing better, nothing less, nothing more. Whereas what we really need is resilience to be built into code, right? No more bricks and sticks in terms of the housing profile of communities that are affected by Atlantic storms and tornadoes and otherwise. And we should be thoughtful about how to build in flood-prone regions, whether we elevate the housing or we create greater distance between incredibly predictable flood zones. All of this has to be a part of our national resilience strategy.
I'm actually really glad that you bring this up, because I think this is often lost in the discussion, right? People assume automatically, oh, we're going to rebuild, we're going to get the money from the federal insurance program or from private insurance companies. But I mean, as you say, as these events happen more frequently, it doesn't make sense to rebuild and rebuild and rebuild and have it destroyed every 2 years again, right? And so I think this really needs a deep discussion about what areas might be off limits if we have to adapt to climate change, that you cannot put zones in there for residential buildings, for instance, right? Or if something gets destroyed, that you might pay people to relocate. Maybe you can pay them a bit more. I know it's uprooting them, but it's important from both their perspective. They don't want to be having and dealing with that every year, right? And from a taxpayer's perspective.
Well, anywhere else in the world, you know, we would be discussing effectively the concept of climate change refugees, even in a domestic U.S. setting. Anywhere else in the world, displaced people in the humanitarian context are known as internally displaced people.
Mm-hmm.
The Puerto Rican diaspora from Hurricane Maria
yeah,
have effectively been displaced to all 50 states.
Right.
We're lucky enough to have U.S. citizenship as a birthright, but nonetheless, this is hundreds of thousands of people.
Yeah.
The out-migration from Puerto Rico goes with culture, goes with local identity, and needless to say, also erodes the economic competitiveness of the island, which was already laboring under a public debt crisis of eye-watering proportions. And so anywhere else in the world, this kind of out-migration or internal migration due to climate risk ought to be tracked and registered as some of the second and third order consequences of this risk profile.
Yeah.
Take things like heat island effect, the consequence of heavily built up urban environments in an increasingly warming world, and hot urban centers are also creating this kind of slow boil environment in which it's becoming unpalatable to spend a summer, for example, in a Phoenix, Arizona, or in hotter cities around the country. This has to be, we have to start tracking this. We can't just merely wait and respond in a backward looking way to the event as it occurs. It's not a sustainable operating model, and we're already reaching a point of diminishing returns with both state level, community level, and federal level disaster response capabilities. We have to start figuring out how to track the advent of these events before they occur, and prepare ourselves as a country and as communities to respond to them before they occur. Because when it happens, it's too late. And what we're showing, I think the data that I'm trying to cite in our conversation today is showing that there is no recovery back to the way it was before. It's taking decades to create the vibrancy that many of the very communities we're talking about had. And that's only getting worse and more complicated.
I think that's a really good point, because I think if we look at the landscape currently, people report, media organizations report on these events as standalone events, but a lot of them ignore the interdependencies, right? Because climate change is a risk multiplier, and you have interdependencies. These are not independent events. If you have a stronger typhoon in Asia and a stronger hurricane in the United States with many more damages than was the case before, those are interlinked, right? And I agree. I think we really have to start tracking them much more, and especially that aspect of internal refugees within a country. And that goes to your point that these areas just don't have the same level of attractiveness anymore, right? People go voluntarily. They don't want to be hit by a hurricane every 2 years, which is understandable.
Exactly. And while I'm a huge believer in the core sort of slogan and philosophy of our country, in the slogan "E pluribus unum," or the motto "Out of many one," nowhere but for in the area of resilience and risk management and response does that motto as a country come into play. But to the receiving community of thousands of people who are disaster displaced or climate change displaced, they didn't necessarily, local leaders and local school systems, for example, don't necessarily contemplate the influx of your own citizens, let alone those that are displaced coming from other countries who might have rightful claim to being climate change refugees because their home environment is under this risk of risks, the threat and the specter of this risk of risks. So that's one example. The other example to this GDP at risk question, and how center city environments are really the engines driving forward the economy in the 21st century, not only the US, but the global economy. Urbanization is a key mega trend that we also have to contemplate. In the fires in California, all of the major urban centers in the state had code red air quality alerts. And so even though the fires might have been localized, the secondary effects of the event made it unpalatable and unbreathable to live under a Martian sky and to live with a potentially toxic air quality environment. Those types of public health threats were with us 5 years ago. Now they're becoming much more prevalent and much more large scale. Remember, 2020 began with the Australia fires.
That's true. We already forgot about it.
And it's ended with a record-breaking Atlantic hurricane season. So it's completely interconnected, and we have to come up with completely different models for addressing it.
Yeah, and I think that also brings me a little bit to the second topic I want to talk about today, which is coronavirus, right? Which is obviously a risk that hit the world economy at full speed. It's a risk multiplier as well, especially when you look at the combination of COVID with climate risk, for instance. And so experts have been predicting a pandemic for quite some time, right? They have said that there is a likelihood, because of different factors like our proximity to the wildlife that is increasing, destruction of natural habitats. And so when you look at risk models, even though it was predicted, How well did those risk models account for something like COVID? Were they resilient, or if not, what can be done for the future to actually improve the accuracy of our models? I mean, if you look at the impact that COVID has had on most countries around the world, it's been devastating economically and health-wise.
Yeah, well, I'll add my name along with Governor Ridge to that list of catastrophe Cassandras who were once upon a time calling for attention to the likelihood of a novel zoonotic disease like COVID-19 not only emerging but becoming a global pandemic. We wrote an article in Harvard Business Review 5 years ago or so calling for one, attention, but two, the very type of supply chain we're now seeing, which is the blend of a public-private supply chain to expedite innovation of breakthroughs, not only in early detection and threat detection, but also prevention and cure. Those strains of the early alert system have to be one of the very first things we start to remedy now that there's a light at the end of the tunnel, however faint, but I think a light nonetheless. But, you know, I think the models weren't the problem. The problem, like the very types of risks we're discussing, was the fact that too much of the world, both the public and private sector, could choose to ignore it on the basis that it was someone else's risk to take care of. And this is where societal risks are a very different order of magnitude event. As a country, we have pledged $5.5 trillion of your and my taxpayer money to address COVID-19, and we're still in the opening innings of this terrible crisis, right? And so in that type of environment, hopefully on the other end of it, just in the same way that a post-war era after the Second World War produced new institutions and completely new thinking, we really have to figure out how to address what does public health look like? What does public resilience look like? And what does the line between private balance sheets and public requirement look like after this crisis? If you were the only company after a hurricane whose generator powered your plant, but everybody in the community around you didn't have lights and couldn't come to work, what good is resilience if it's only for you? We have to figure out how to extend the line and do so in an equitable manner, but do so also in a manner that that has business thinking and business impact at the other end. Pfizer, notably, is not a company that's a part of Project Warp Speed, but nevertheless, Pfizer's balance.
I didn't know that. Okay. Yeah.
Pfizer's balance sheet has Pfizer's balance sheet and its R&D capability have an opportunity to save many millions of lives and start to put this crisis back into check. But should that be the only model? Can't we spur public-private innovation in this domain and extend that perimeter of defense not only to our country, but around the world?
Yeah, because it's a global pandemic. I mean, you don't get it under control unless you get it under control globally. With all the travel that we have and which is expected to pick up again, even if we get a vaccine, it's just not feasible, right? Yeah. So let me talk about the parallels between COVID and climate change. There's been a lot of discussion on that. How similar do you think these two issues are from a risk management perspective? And can you actually draw some lessons from COVID that could be applied to climate change?
Well, I think you absolutely can. First of all, and this is where I think even I might have gotten this wrong in the book I co-wrote a couple of years ago, Global Risk Agility. We talked about these big four risks, climate change, infectious disease, socio-political risk, and cyber risk being kind of the big risks that would shape the world in the foreseen years. I anticipated that we had much more time, that these were horizon issues and we could think in decade-long spans. What 2020 has taught us, however, is that the onset of these risks can come faster and they can be much more furious and global in scope than we had ever anticipated. Yeah. And, you know, COVID-19 is a wake-up call that when this occurs, all of the issues we had discussed thus far are on the table, and they're on the table in real time. And in that environment, there is no fire drill. You're now operating in a crisis, and the crisis could have big implications, not only in terms of loss of life, livelihoods, but the dislocation of generational wealth. In the first quarter of next year, we're going to be a country with the largest debt to GDP burden we've ever had. Yeah. And there's only so many more times we can continue passing identifiable economic risks that ought to have private sector solutions to the public balance sheet before the economic clock tips over into midnight. And we simply cannot do that anymore. It's an operating model without a particularly gratifying end if we keep it up. Yeah. COVID-19 teaches us that these things are real, these threats are not abstract, and the horizon, frankly, is much shorter than we had ever thought. Climate change in that sense is the perfect parallel. It is the risk of risks. It is unincorporated. Most companies and most communities have anticipated that it isn't a horizon issue in their lifetimes. And every single one of us ought to look in the mirror and ask, what will I do when it happens to me? And already there are millions and millions of examples in our country and around the world that are telling us the risk is here. Climate risk is here. I discuss it in the present tense. I don't say climate change. I say climate changed, and I want to spur action in the real time.
I like that, because I think oftentimes people forget, especially depending on where they live. Oh, as you say, it's something that will affect me in the future, maybe, or my kids or grandkids. But for a lot of people, especially around the world, it's already real, right? If we look at the islands in the Pacific Ocean, they are facing already loss of habitat, loss of living space, and have to think of where to relocate. And that's a fundamental issue, right?
No, absolutely. It gets to this disaster displacement question. I mean, I wrote a piece again a couple of years ago after Hurricane Maria devastated Puerto Rico, where I'm from, that basically said, you know, the small island nations in the Caribbean basin in particular are the canaries in the climate change coal mine. That what we had in Puerto Rico was the second longest blackout in modern history. The first was also caused by a cyclonic storm, Hurricane Haiyan or Typhoon Haiyan in the Philippines. In terms of kilowatt hours per household, we have the dubious distinction of being the second longest blackout in history. In that environment, resilience and community resilience and the inability of driving a nationalized response really lays bare of the stakes. And so think of what happened in the same way that Italy was the canary in the United States COVID-19 coal mine that warned us that something real was coming in the form of this crisis, but we conveniently perhaps chose to ignore it. The experience of Puerto Rico in the face of Hurricane Maria is a teachable lesson of the stakes. When the public infrastructure fails and you're sitting in darkness for 6 months, and thousands of lives are claimed, more than 6,000 lives were claimed, because while a certain number were claimed directly consequential to the hurricane, if you had a treatable illness and you couldn't get to a hospital system that had electricity, that treatable illness became a death sentence on that island. That is a moment that ought to teach the rest of the country what the stakes are. And in that environment, again, nationalized strategies around resilience and shoring up the country need to be tabled. And we have a chance to do it and to do it right. Yeah.
Well, this is wonderful. We are out of time, but this has been really interesting. And I really thank you for your time and your insights. I know you're really busy, and so we appreciate it. Thank you.
Thank you so much, Sanjay.
And all the best to you and your family in this crisis.
Likewise. Thank you.
Take care. Bye.